Hi there, welcome to the closing bell on the 15th of Jan. This is going to be a pretty short and sweet one because the markets are dull. I cannot believe this market has been treading water for 8 months now, the ASX 200, and we're also in the holiday period. We've got the market scratching their head with the Fed on the edge of changing tack and raising rates in a few months, and possibly, we heard last week, letting their bond portfolio roll off. Now that is the big news for me. And we saw the US bonds really sell off quite sharply. I have been keeping you in tune with what's been going on in those bonds over the last few months, if you have been watching these videos. And I showed you the setup where I think those US 10-year bonds above 1.8% can look a little bit scary. And we saw last week a spike up to that level. So we're getting close to that breakout level. So I want to show you that. Also, oil's looking pretty good, but boy, there's not much else going on out there. As I said in my article, my best mate, who's a trader, is down windsurfing down at Inverloch at the moment, and I think he's in exactly the right spot, quite frankly. So I'll show you a few charts, and then I'll let you get on with your day. So let's just have a look at the US bonds. I want to start out by showing you the last few decades of the US bonds trading and how they've moved. This is going from 16% all the way down to their current level of around 2%, that US 10-year bond yield under 2% at the moment. And the reason why I wanted to show you this sort of generation-long fall in yields is to consider the fact that right now, inflation just the other day came out at 7%. Over the last year. So inflation figures at 7%, US 10-year bonds yielding 1.7% a year. So over 1 year, you have dropped 5% of your capital owning those US 10-year bonds. Now, we're not going to see those bonds sell off in a straight line to 7% to make real yields zero. For one reason, inflation's not going to stick up around 7%. It's been a bit of a spike over the last year. There's been a few extraneous issues that have really been kicked it higher. But also, inflation's not about to drop all the way back to 2% in a straight line. They've had a massive impulse of printed money shoved into the system post the COVID crash. And it really feels like that was the straw that broke the camel's back with inflation. And we've had a massive uplift in demand post-COVID without production really coming through due to all the shutdowns on COVID and all of the supply chain disruptions, et cetera, around the world, with semiconductors, all that sort of thing. So what we've seen is this printed money and this massive spike in demand and inflation really taking off like the clappers. So it's a pretty interesting time. And whenever the Fed changes their tune, you really want to sit up and take notice. This is the first time in a long time that they are changing tack and they are starting to raise rates. And if we look at this US 10-year bond, when you look at it in the big picture, it's still trending down, isn't it? There's no way that you're saying this downtrend is finished yet, but if we're looking at this downtrend and where we are currently, I'm sort of concerned if I just take all of that as a move and then down here, it is just in the early stages of kicking up to the upside. And the long-term trend has shifted up in yields. This is actually a chart of the US 10-year bond yield chart. So when that line is going up, that means yields are going up, the price is going down. So I want to make sure you understand that. But the fact that we're now kicking up and that rates are heading up through that 1.8%, I need to go into the shorter term just to really give you a sense of why I think they could spike if they do head much higher than here. This range that yields have been in the past decade. So here's your initial range. And I've gone through this before with you if you have been watching these videos. And you've got these false breaks of either edge of the range and the yield goes back to that midpoint, back to that point of control. And we've had another big break in that COVID crash where yields dropped all the way to 0.4%, but they have been rising since. And last year, the high end yield was around 1.8%, which is where they got to last week. And that is the line in the sand for me, where I think above there, you do have to be careful. I think the setup is that the long-term trend is up in yields. We've had one wave higher. We're going to a second wave higher, breaking out above 1.8%. It really should have a pretty quick trip up to that midpoint, up around 2.2%. And I'd be interested to see what the tech stocks would be doing then. If it's a very sharp, quick move, I think equities could struggle a little bit. And really, it could even rotate higher. It could even start to threaten up around that sort of 2.5 to 2.8% region. So I don't know what's going to happen above 1.8%, but I just think there's a heightened risk that the sell-off in those bonds could accelerate. The Fed is backing off, saying that they're raising rates and they're going to back off from increasing the size of that bond portfolio. And as their bonds roll off, they're not going to be buying more with the money that they get back. So that is a tightening. That is money, printed money, that will be coming out of the system. So, it really is a big event, and you're not going to have that Fed in the market just buying those bonds as they have been, and everyone else in the market front running them to hold on to those bonds. You've got inflation at 7%, those bonds at 1.7. They're not looking like a great investment to me right now. So there's no reason why they couldn't shoot to 2.2 to 2.5% on a wave. And that will put the cat amongst the pigeons in equity land. So you have to be aware of that. So that's the first major thing I wanted to point out. And this is a long-term chart of oil prices. It's about the only thing I see out there that's really looking strong and I think can break out. This is a chart going back, for a decade. You've got the old high back in 2018, and that's the sort of major thing I've been keeping an eye on. And we saw oil rejected from that area a few months ago, and it sort of sold off. And the quick analysis of this is that we've got this uptrend from that COVID crash low. And you can see that the most recent wave down fell to the buy zone of that wave there. So that the uptrend is totally intact. The price would actually have to break below that highest low of that wave to be saying that the trend may be over. So the uptrend, totally fine. We break out above that sort of $85, $90 region. Where's the resistance? You can see that there's not much resistance, and prices could really rocket higher, up above $100. So right now, oil prices are looking pretty hot, and you're seeing stocks like Woodside, Beach, Origin, those sort of stocks are picking up. And I have been saying to you months ago that I didn't mind the look of those. So, definitely oil looking all right. And just quickly on gold, we've been talking about gold for a while as well. It is picking up, it's holding in there. The major point I'd say about gold is we've got this big rally from 19 to 20. Then we've got the correction that you can see there. And I was making calculations off that correction. And you'll remember that sort of buy zone of the correction coming in around this sort of 1720 to 1760 region. And it has found support there again, which is a good thing. I really needed to see prices, busting back below the low of the whole correction around 1680. Then I'd really be getting concerned that gold was going to have another serious leg lower. But that hasn't eventuated. And it's still holding in there. I probably need to see it above that 1880 region. And then my conviction will increase quite dramatically that we are going to see a bit of a spike higher in gold. But for now, I think gold looks pretty constructive. So I'm just going to finish up with the ASX 200. This is the monthly chart going back a long way. I'll just start with this period you can see there in the top right of the chart, that is 8 months trading in a very tight range. And the thing I was discussing in the article, and which I've discussed with you in the past, but just to recap, these old major highs from 2007 and from 2020, they're very important, because if this is tracing out a topping formation, spending months and months and months above the old high, but not really carrying on with it, and then prices tip over and have the false break of those two major technical levels, all of a sudden a mean reversion move can happen. Bit of a panic sets in, because all the people who have been buying on the way up, all of a sudden they thought they were way in the money, and they're not. And before you blink, if the music stops, prices can plummet quite quickly. Doesn't mean it won't end up turning around and being a great time to buy and things will turn back up from there. But it is just a bit of a setup for me that we've had a long, drawn out sideways motion above the old highs. Could be a topping formation. We've got the Fed taking away the punch bowl, tech stocks under pressure. I'm just a bit wary that, another few hundred points to the downside and the dominoes could start to fall. So I've set people up to, taking profits and taking it pretty easy, and just wanted to give you that sense that it's not a time to be gung-ho out there at all. All right, well, that's enough for this week. It is a pretty dull market, but yeah, keep an eye on those bonds. And look, check out what I'm doing. Look at the links below the video. Just click on those. You'll find out about Australian Small-Cap Investigator and Pivot Trader, which are two services that I run. And I'll come back with more next week. All right, cheers.